So for my talk today, I chose to present some work on initial coin offerings. This is joint with my former PhD student, Reina Gan, and my colleague, Sergey Natesin. The title has changed a little bit from the announcement, so don't be too alarmed. It's still the same presentation. We just changed the title to emphasize the asset tokenization aspect a little bit more, but it's still very much the same talk. So to kick things off, imagine you're an entrepreneur with an innovative product, but no funds. So in addition to all the obstacles you're facing, you also need to figure out how to get the capital you need to grow your business. So traditionally, you could aim for bank or VC financing. And there's, of course, very, very large literature on these channels and on their economic implications is very well understood. On the other hand, I'd say over the last decade or so, there have been new channels that have popped up in Fintech. Now, when people hear the word Fintech, they often think of payment companies like PayPal, but there's another side, which is the capital raising side, where there have been a lot of really interesting developments in the crowdfunding space. These developments include things like the reward-based platforms like Kickstarter that I'm sure a lot of people are familiar with. And even more recently than those crowdfunding platforms, we've had what I would call an additional evolutionary step in this whole process, which is that of crowdfunding on blockchain-based systems. And these are typically referred to as ICOs or initial coin offerings, although there are other names as well. So the literature on these is newer. It's actually quite big already. There are a lot of people working on this specific aspect of token financing. And this topic will be my primary focus today. All right. So as a first step, let's just go over a basic introduction of ICOs to make sure everyone's on the same page. Now, in the interest of time, I'm going to assume that everyone is already familiar with the general concept of crowdfunding. Now, feel free to stop me if that's not the case, or feel free to stop me for questions or for anything else if I'm not being clear, if the internet is breaking up. Please let me know. So I would say ICOs are a form of crowdfunding, but there are two important differences. So one is that there's typically no intermediary. And so the firm really has full control over how to design the ICO and how to invest the proceeds that it can get from the ICO. The second difference is that ownership is represented by tokens. So the way it works is that backers that want to invest in the firm send digital currency, and in exchange, they get some tokens that are typically tied to one of two future items, right? So they're either tied to future products or services that the firm eventually produces. And in this case, people refer to this as utility tokens, and these tend to be unregulated. This is changing slowly depending on which country we're talking about. For the most part, they're still unregulated, and the talk will be mostly on these. Now, another possibility is equity tokens, and these are more classical in the sense that they resemble shareholder equity, and they're typically tied to the firm's future profits. So generally, these are referred to as STOs, which stands for Security Token Offering, although in my talk today, I'm not going to make the distinction. I'm going to talk about ICOs with utility tokens versus ICOs with equity tokens. And these are different for a variety of reasons, but one of the reasons is that they tend to be regulated in almost every country. So let me mention one more important thing that this is going to be at the core of the talk today, which is that these tokens are tradable in the sense that as an owner, if I decide I want to, if I decide I don't want to use the firm's products, I can try to sell my tokens at some, let's say, fair market price to someone else who might want to use the product. And what I think is interesting about this is that it can lead to a lot of speculation. And I'm going to comment a lot on speculation throughout the talk as we go over the slides, so I'll leave the discussion for a little bit later. But before I move on, are there any questions so far? Okay, I take the silence as a no. So next I want to dive into the example that motivated the paper, but before I do that, let me show you an overview of the ICO market. at least as of 2018. So I think this is a pretty interesting chart that's done by one company. I don't have the name of the company on the slide here. Most of the activity in ICOs started in 2014, but really occurred 3 years later in 2017, 2018. So on the bottom here, you can see a timeline where you can see all the activity that's been going on since 2014. And on the top left, you can see the total amount that's been raised so far from 2014 until August 2018. So 28 billion is really a significant amount. It's much more than typical crowdfunding like on Kickstarter. Those are not the types of numbers that we see. And it's actually, just to compare it, it's on the level of the yearly US venture capital market. Now, of course, these are worldwide numbers. And one thing you don't see on this chart is that after 2018, there was a really big dip in the ICO issuance volume. This happened for many, many reasons. One of the main reasons was because regulatory entities started to crack down on a few high-profile cases. But also, customers started becoming a little bit smarter, et cetera. So you have seen a decrease that is not very well observed on this limited graph here. So I think it would be interesting to explore this kind of boom and bust cycle of ICOs. I don't actually know of any work that's specifically focused on that, and it would be interesting to look at it, but I'm not going to address it in the talk today, other than to recognize that it's true and it's there. So here, I really like this chart. Each bubble represents a unique ICO, and it's scaled by its size. And the different colors represent different geographical regions. So with blue is Europe, orange is North America, green is Asia, et cetera. So you can see kind of the distribution, it's somewhat even across these regions. Now, a quick comment, perhaps the most influential ICO of all of these bubbles is actually the Ethereum ICO, which is down here, if you can see my mouse, in, I guess, pink. It only raised 19 million, so it's a small bubble, but Ethereum was instrumental in developing the technology for all these other ICOs to happen. So the bubble size can be a little bit misleading in terms of how important each one of these ICOs is. You can imagine there are a lot of interesting stories here. These are all different companies. They're, for the most part, trying to do different things. The biggest one is EOS that you can see on the right here, raised $4 billion, which was a little bit insane. And EOS is essentially a platform that's trying to compete with the Ethereum platform and had a lot more capital, although it's kind of late, came later in the game. Now, I'm going to skip the broader discussion. I'm going to ask you to focus on one specific bubble, which is the one that's right in the middle of your screens. This company called Sirin Labs that raised $158 million. So this is a company that motivated almost the entire paper. And I'm going to take some time to discuss the company in detail and why we thought this was really interesting. Okay, so a few years ago, Sirin Labs had an idea for a smartphone that was based on the Android ecosystem. So you can see the smartphone here on the left. It had an interesting twist that it wanted to embed inside of this phone a cold storage wallet for cryptocurrencies. So a cold storage wallet, perhaps people are familiar with it, but it's basically a wallet for your cryptocurrency that's not connected to any type of network. And the idea they had was that they could have a separate piece of hardware on the phone that would connect and disconnect only when, so it would connect only when transactions needed to happen, and the rest of the time would be completely disconnected from, the Wi-Fi and any type of network. I haven't planned to talk more about the technology. I'm happy to, to do that later during the Q&A if anyone's really interested in what this phone is doing. Now, as is typical for many ICOs, Sirin wrote a white paper to try and explain its vision for the phone and how it designed the ICO. And I've highlighted a few of the items on the right here, just the ones that are going to be relevant for the talk. So first, they decided to issue tokens amounting to about 40% of the company, and this is called the hard cap. So this, you can imagine, is a design parameter. Now, the other design parameter is the token price in the ICO. And in this case, it was set at 47 cents. Now, the company also provided some guidance on how much they expected the device to sell for. They thought that the retail market for this was about $1,000, or at least that was their understanding of customer willingness to pay, was at about $1,000. So it's kind of in line with a lot of other phones, 2 years back or 3 years back. But to buy the phone, and this is kind of the whole point, you needed to first get the firm's tokens as a customer. And then once you get the tokens, you would exchange the tokens for the phone. Okay, so what else? So with a little bit of searching, you can find the per unit manufacturing cost, which was in line with the rest of the industry. It was about $400, and their expected margin was about 60%. Now, I have the margin in bold because margins are actually going to end up playing a really important role in the model. I'm going to ask you if you can please try to remember this 60% margin number as when I eventually get to the model, etc. Okay, last two things. There are some things that are worth mentioning that are somewhat relevant to the model. The first one is that this company managed to get, and I don't know how they did this, they got Foxconn as their manufacturer, which I'm sure you all know that Foxconn is the company that does Apple's iPhones. And so imagine you're a potential customer interested in this phone, you see Foxconn, you can feel pretty reassured that the technology behind the phone is viable and there's no risk. The second point I want to mention is that they had some amount of star power going for them. They managed to get this gentleman over here to serve as the brand ambassador of the entire company. Anyone have any ideas who this is? He's basically one of the most famous people in the world, though he's not wearing his, yeah, it's Messi, that's right. So I think there's a lot, I usually give this talk in American universities, and sometimes they don't actually know who it is. He's not wearing his uniform, but this is Lionel Messi, arguably the world's best soccer player. If you disagree with that, we could take it offline. That's a big debate there. So he was actually promoting the phone, and imagine you're a customer, you're looking at Foxconn, you're looking at Messi, you feel, I guess, pretty excited about the prospects of this product. So what happened with this company? Well, they had a fantastic ICO. They raised $158 million. And imagine that this was done without an actual prototype. Now, if you consider the advertised price of $1,000 per phone, this would be equivalent to a pre-sale of about 150,000 phones. Now, I'm making two implicit and wrong assumptions here. The first assumption I'm making is that the company would not just run away with the money that it raised, or would not divert those funds. And so keeping in mind that this ICO was completely unregulated, it wasn't registered. And so it's a pretty big if that they're actually going to take that money and put it towards producing those phones. The second point is that I'm assuming that people who actually purchase the tokens would want to use those tokens to get the phone. And you can imagine things didn't exactly work out that way. So it went nicely at first. They had a lot of money through the ICO, a lot more than they thought they would raise. And to answer my first concern, they actually made the phones. They were successful of actually producing this product with the new technology that they were offering. And so they did invest some of the ICO proceeds into phone production. But after that is when things really went south. So unfortunately, what happened is that no one actually bought the phones. I'm exaggerating a little bit, but essentially realized customer demand for the product was just very low. And the firm subsequently lost 97% of its value over the next year or so. So I think it's reasonable to infer that most people who bought the tokens here were actually speculating. They weren't interested in buying the phone. They were hoping to be able to sell the tokens for profit to customers who would be willing to buy the phone at some later date, right? And we can ask, what would drive the token price up in the ICO? Or what would drive the token price up after the ICO? Right? Which is a more relevant question. So intuitively, since the tokens are linked to the phone, customer demand for the phone should be driving token value. So we're going to be exploring this really intuitive link more formally in just a few slides, and I'll show you some concrete math that captures the relationship between these two things. Now, we can also ask the following question. So how common is this type of speculative behavior in ICOs? If you guess that it's very common, you're right. So we actually have some empirical evidence from this paper on the bottom that this happens more than the majority of the time. So it's really a speculative market. Probably not too much of a surprise, although to be honest, I was surprised given this is a concrete product. It's not some promise of some platform. And keep in mind, they had Messi and they had Foxconn, et cetera. Despite that, it was still all speculation. So this secondary market that enables token buyers to resell their tokens to someone else is really an interesting part of any ICO and of the token economy for the product. And I'm going to spend some time, in the rest of the talk to really discuss this. So here are the research questions. We thought there were several interesting questions that we could ask, starting with the overarching theme. What is, whether this type of asset tokenization is viable? When I mean this type, I mean you have a concrete asset like a phone and you want to tokenize it. So for the talk, I'm going to raise three questions. So number one, how do we design ICOs for product market firms facing customer demand uncertainty? So these are really the two key items here that are going to allow us to differentiate ourselves when this paper was written compared to the rest of the people studying ICOs. So we wanted to know, so how many tokens should be issued? At what price should these tokens be issued? And once the company raises some funds, how much of those funds should it invest into these phones? Related to this last point, the second question is on moral hazard. So how is moral hazard dealt with in this setting? The nagging question that I had at the beginning was, why didn't this company just run away with the ICO money? Now, you've raised a bunch of money in an unregulated way. What keeps you in the game? There are, of course, a lot of behavioral explanations, including maybe they didn't want to disappoint Messi. But we're looking for a rational explanation in the paper, so it's going to be that you have to have some incentive to produce after the ICO. And related to that, what's the impact of speculation on the secondary market? And finally, the third question, now it's natural to think that because we're actually selling a product, it makes sense to tie the tokens to the product. It's just what Sirin did, and it's what, a natural thing to do. But we were wondering what would have happened if they had instead issued equity tokens instead of utility tokens for the phone. And I think there's going to be enough time. I'll try to do my best to get to it. So to answer the question, what happens when you do equity token issuance instead of utility token issuance? Okay, so you can see that there's a lot of strategic interactions here between the various players, and we're going to tackle these questions using a game theoretic approach. Now, I'm just going to spend a very small amount of time on the literature. And in brief, you can see that there's a lot of papers on ICOs, perhaps more than would be reasonable at this stage. Now, only a few have been accepted for publication, which are in bold. But compared to all these papers, as I mentioned earlier, the high-level contribution was the primary focus on products. The other papers focus primarily on service platforms with network effects. We focus on product market firms, no network effects. So that's what this paper is about. We're trying to tokenize future inventory, basically. And this type of asset tokenization hadn't been explored at the time that we were studying this, at least to the best of our knowledge. Now, the paper is broadly related to many other literatures on crowdfunding and, of course, on blockchain systems. And I didn't even try to list because there's so many people affiliated with in Toronto in general working, so that no matter what I did, I would leave people out. And this is trying to contribute to that literature, but it's more on the economics side and on the token economics to be more specific. Okay. I'm going to pause just for a second in case there are any questions in the chat or anything before diving into the model. Get a sip of water.
If you'd like, if you want, you can just private text me. If you don't want, you could pose it publicly, or you could just private text me, Henry Kim, and then I can wait till the end and ask the questions in a
Sure.
bunch. Okay.
Okay. Thanks, Henry.
Thank you.
Okay, so let's dive into the model. So you'll see the model is quite stylized, but it's heavily inspired by the Sirin Labs example. So consider three sets of players: the firm, token speculators, and product customers. And we're going to consider three periods: the ICO period, the production period, and the market period. The firm's going to have three decisions to make. The first two are going to be on how to design the ICO. And so what does it mean? It means the number of tokens to sell. We're going to call that little n out of m. So n is going to be the number of tokens, the maximum number of tokens to sell in the ICO, and m is going to be the total tokens representing the entire company. So the ratio n over m for the case of Sirin was 40%. Okay, then the other decision is the ICO token price. We're going to call that tau. And the third decision is, once the ICO proceeds have been raised, if any, how much do I use to actually put into production? We're going to call that production decision or investment in production decision, a quantity big Q. The product is really simple. It has a unit cost C. It's going to be priced at some equilibrium token price that's given in terms of dollars per token required to buy the product. And it'll be acquired in a secondary market or after the ICO, basically after production is finished. This tau ec is going to be derived via just very standard market clearing conditions. And let me also mention here that everything in blue for the rest of the slides is going to be a decision variable. Everything in red is just going to be an equilibrium quantity that comes out of the analysis. And everything in black is just going to be an exogenous parameter that's assumed. There's a decent amount of notation. Don't worry too much about it. I'll repeat the notation as I go through this. Okay. So we have two more agents to talk about, and they're very simple. They're modeled in a very simple way. So we have speculators. There's some equilibrium quantity that show up that we're going to call little s for speculators. And we're going to make the simplifying assumption that they each buy either one token or 0 tokens. And if they do buy a token, they will try to sell that later to customers for a profit on a secondary market. Now, their utility is really simple as a result. It's just proportional to the expected price in dollars that they hope to get in the future, which is the expected value of tau ec, minus what they paid to purchase the tokens, which is just tau. And finally, customers. It's a very simple customer demand model. They're homogeneous with respect to their willingness to pay, little v. So you can think of little v, for instance, as the $1,000 that people were willing to pay for the Siri phone that I mentioned earlier. And there's an uncertain number of customers. This is kind of where the interesting part comes in, that we don't know what customer demand is going to be. We're going to call that D. It's going to have some CDF with some mean mu and some standard deviation sigma. Okay. And the critical assumption here is that for customers to be able to buy the phone, they need to first buy the tokens. And where are they going to get the tokens? Well, they either get them from speculators or they get it from the firm directly. Okay. So the speculators and the firm are going to compete in that sense to sell tokens to actual product customers. Here's the sequence of events just to summarize everything. So the firm publishes a white paper in which it lists the ICO design parameters, so the price tau and the tokens available n. Then there's the ICO period, where speculators arrive and then decide to either participate or not participate in the ICO. Once that's done, the firm observes how much money it raised, and it makes an investment decision in production in terms of how much money should be spent towards production Q. So this is here. Then, so there's a production period that we don't model explicitly. And when production is done, we assume that D is realized, so demand is realized, customers show up, the product is ready, and the market clears at some equilibrium level. That's going to set the price tau ec. Okay. Here's the mathematical model, bringing all of this stuff together. This is what the game looks like. This is what we solve analytically. So the firm maximizes its profits subject to budget and participation constraints. So the first constraint here, let's talk about the constraints and I'll talk about the profit. So the first constraint says that you can't spend more money than the amount of money that you had in the ICO. So the left side is how much money you raised in the ICO. It's the token price tau times the number of tokens sold, or the number of people who showed up to buy the tokens. And CQ is your production cost. It's how much you need to build to make these products. And it depends on how many products you make. It depends on Q. Okay, so the second constraint just says that speculators participate in equilibrium. If they don't participate, there are no funds. So we make another simplifying assumption that the firm doesn't have any of its own funds when it starts this. Okay, so the profits are composed of two sources of revenues and one source of costs. And this is really going to be important. It's going to be driving a lot of the results. So the revenues are, number one, the original ICO proceeds that you can see here, which is the token price times the number of tokens sold. And then, importantly, the firm can potentially have more revenues by selling tokens to customers in the secondary market period here. So M minus S is just the number of tokens the firm maintains after the ICO. Now, if S is equal to M, that means the firm doesn't maintain any tokens. And the expected value of tau X is just how much they're worth in expectation at the time that the production decision has to be made. And the cost, so that's the two sources of revenues, and the cost is just CQ, the production costs. Now, hopefully you find this to be quite intuitive, but of course there's a lot of complexity that's hidden in these equilibrium terms in red, S and in tau X. These depend on other things, exogenous parameters in the problem, and that's where the complexity is coming from. Let me emphasize one important thing here that you can immediately see in the mathematical formulation. Q equals to 0 is a feasible strategy on purpose, right? So this corresponds to the 100% cash diversion case. You can check that if you set Q to 0, production costs go away. And if the equilibrium is done right, there should be no token sales because there's no product in the future. So this should go to 0, but then the firm is left with tau S, meaning it's left with the ICO proceeds, and that's its profit because it's not regulated. It can just completely run away with the money. Okay, so why did we decide to model this most severe form of moral hazard? Well, for one, this happens actually about 15 to 20% of the time based on some empirical papers that I've read and some press articles, things like that. But also recognizing that speculators are strategic, they can completely prevent this outcome by just not participating. You just don't participate. And this leads to the question of whether there is a market breakdown in the sense of Akerlof's Market for Lemons paper here, or whether the market can somehow still self-regulate absent any government regulation and actually lead the firm to produce some non-zero quantity Q and not run away with the money. So that's kind of the fundamental question that we first, when we wrote down the model, that's what we wanted to know. Okay, here's the analysis. It's going to be done via backward induction. Just the standard way, we start with the final period where there's the market period where the market clears, and we need to figure out the market clearing price after customer demand is realized. I'll show you that in a few slides. Given this price, we derive the firm's optimal operating strategy. And given the optimal operating strategy, we then derive the optimal ICO design parameters. How many tokens, should the cap be, and what's the optimal price of the tokens tau? So it turns out that even though the model looks simple, the analysis is really quite lengthy and really complicated, despite all the numerous, simplifying assumptions that we made. So I'm going to skip over basically all the details of the analysis and just focus directly on the results. All right, now before showing the results, under moral hazard, I need to define the first best benchmark, which is really simple in this case. So if you assume away cash diversion completely, we get without too much surprise that the classical result of Modigliani-Miller, that there's a complete separation of firm financing and operating strategies. So in this case, the firm's operating strategy is actually quite simple. It reduces to that of a standard news vendor model. So the news vendor model is was first introduced by Arrow in the 1950s and for inventory management. And so we get this classical result here that says your optimal investment in production is going to be 1 minus C over V, which is the margin. And we take the inverse with respect to the customer demand CDF. Okay, it doesn't depend on any ICO parameters because that's the Modigliani-Miller theorem there. It doesn't depend on M, it doesn't depend on the token policy, etc. Now, I'm going to ask you if you could please remember this simple formula, just the inverse, F inverse 1 minus C over V, and we're going to revisit this in a few slides to see how things change when we add moral hazard. Okay, so having defined the benchmark, let me jump to the equilibrium of the game with moral hazard. We obtain the following. With a relatively simple condition, which is just V bigger than 2C, meaning product margin bigger than 50%, we find that a unique non-zero equilibrium exists. Now, the expressions for the equilibrium are a little bit cumbersome, so I'm not showing them here. In fact, we don't have fully closed form solutions. But in brief, we obtain the optimal ICO design parameters and the optimal investment level as a function of the three sets of things that you can imagine. So the total number of tokens of the firm, the product cost, and all of the customer parameters, meaning the willingness to pay of the customers and the demand function F that has the mean and the standard deviation embedded. So through those expressions, we can then do some comparative statics, which are pretty intuitive. So I'll just briefly mention a couple of them now. So for instance, without too much surprise, we find that moral hazard goes down as product margins go up. And I say this without too much surprise. The reality is, with hindsight, it was easier to understand. This is not something that we had guessed beforehand. Maybe perhaps we could have. What we also find is that moral hazard becomes worse as customer demand volatility increases. So if you increase the sigma, if you have more uncertain customer demand, you have worse agency costs, basically. So at this stage, you might ask, okay, so what? We've solved this problem. It's a stylized model. It's not like someone's just going to take the model and use it right away in practice. So what do we learn from all of this exercise? And for that, I want to dive into some of the details. So here is the first thing I want to talk about, is that ICO failure essentially depends on margins in the model. So when you do asset tokenization in this context, margins are going to be a critical driver. So the reason that the ICO fails if margins are below 50% is because in that case, you can show that there's actually always going to be 100% cash diversion. No matter how good you expect customer demand to be, because the firm isn't operating with its own money, the firm would always prefer to run away if the margins are not at least 50%. This is not dependent on the model. This is more or less model agnostic. Now, once you hit the 50% margin, then equilibrium, it makes sense to have an ICO. And how successful the ICO will be from that point forward depends on the margin, but also on all of the customer demand and product characteristics. So what do we learn? So if we compare the condition V bigger than 2C with a condition V bigger than C. So V bigger than C is the condition that we get in the first best case. So as long as customer willingness to pay covers your costs, in the first best case, you invest. If you do an ICO, however, it's not enough. You need V bigger than 2C. So we get this classical underinvestment result when profitable startups that are in the range between C and 2C, they're profitable in expectation, but they cannot get financed, or they should not get financed via ICOs. Okay, now the other important, and this is probably expected, but the other important insight is that underinvestment persists even when the margins are high enough, and it only really goes away asymptotically when the margins tend to infinity. So let me show you how I see this and how you can see it as well. For that, I need to show you the expression for the optimal investment level that's given here. Now, if you compare this back to the first best expression, it only differs by the extra factor in yellow. And the extra factor in yellow depends on how many tokens were floated in the ICOs. This is N star. So this was the cap, how much, the maximum number of tokens. And it depends on M, the total number of tokens of the firm. And you can see here that for any float strategy N star, the factor in yellow is always going to be greater than 1. And this immediately translates, because of the inverse properties of the demand distribution, it translates immediately into a lower Q. So even in the case of high margins, there's going to be some investment, but it's not going to be optimal investment. All right. Now, another important takeaway is that Q depends on the ICO cap, which is N star, the yellow term here. And recall in the first best case it didn't. And so the bottom line is that it's not too surprising. Modigliani and Miller fails in this setting. And we have a complete entanglement between the firm's ICO design strategy and its operating strategy. You can't separate these two things anymore. The takeaway I would tell startups is that holistic design is critical. You need to design your ICO in a way that takes account of the type of product you're trying to tokenize, the types of customers you think you're going to face. It sounds trivial, but it's not easy, because if you think about it, most of these startups don't even have a prototype at the time of the ICO. All right, now, given this optimal operating strategy depends on the float strategy, we can ask, so what factors drive the optimal float strategy? And let's dive into those next. All right, let me provide some intuition. So everything else being equal, the more tokens the firm floats in the ICO, so on the plus side, you can imagine, well, there are more tokens, it might be able to raise more money. It's giving a larger share of its business. But on the negative side, the less tokens the firm has left to try and sell later in the secondary market. So at the extreme, if the firm gives out all of its tokens in the ICO, it has 0 tokens left to sell those tokens into the secondary market. So what does this mean? It means that after the firm is done raising funds in the ICO, absent penalties and regulation, its incentive to invest in production goes to 0 if it doesn't retain any tokens itself. So this, I think, is an interesting result. And keep in mind, we're not giving out equity here. And what we're saying is that you still should not give out all of your utility tokens, because there's a fundamental trade-off that the firm needs to resolve. It's between the number of tokens to give out initially, so that dictates how much money is raised, versus the number of tokens to keep, so that the firm retains enough skin in the game that it can then credibly put those funds into production, because it wants to produce, because it wants to sell the phones through the tokens that it has left. Right, so this N star, we obtain an equilibrium. It just represents the resolution of this tension between money now versus money later. And in that sense, we can say that N star kind of controls the amount of moral hazard. Okay, we now know how many tokens to issue. We can then ask, how do we price these tokens? And there's going to be, you can imagine, a very similar trade-off, in the sense that if the price in the ICO is set too low, there just won't be enough funds raised. But if it's set too high, there won't be enough upside left for speculators. And so the speculators will actually be reluctant to participate in the ICO. So one thing that, more high level this implies is that token issuance and token pricing control different things. They're not substitutes. They don't perfectly substitute each other. So the implication for startups is that it doesn't suffice to figure out how much money you need. You actually, in the context of asset tokenization, you have to set both of these controls to very specific levels if you want to maximize profits, because they control different things. And I think that was an interesting takeaway that was a little bit counterintuitive to me. I thought that maybe just the total amount of funds raised would be enough, but it's not. You really need both of these controls. Okay, now we can ask, where's the sweet spot for these two levers? So what we find is that in equilibrium, the price tau and the cap n will be set at a level such that all the funds raised in the ICO will credibly be invested in production. Meaning in equilibrium, the way the model works, there can't be any cash diversion in this model. Intuitively, it's straightforward to argue that raising any lesser amount would be suboptimal because it artificially limits production. Remember, we have a profitable product here, a margin of greater than 50%. And similarly, if you raise anything more than this amount, that's also suboptimal because, this is more subtle. In brief, you raise more money than what you can credibly put towards production. And what that means is that you're effectively diverting cash into your pockets. But speculators know this, and overall, it comes at the detriment of speculators. And so the idea is that because speculators are fully strategic in this model, they will ensure this doesn't happen. So in essence, they stop pumping money, or they should stop pumping money into the ICO once they see that total funds raised is hitting this level of CQ. Okay. Last slide. This is just to wrap up our deep dive here. And I think there's one more result that's worth discussing, which is the link between ICOs and revenue sharing contracts. So for this, let me show you one last formula, which is the equilibrium token price that we obtain in the secondary market, which is also a really simple expression. I don't have the clearing mechanism here on the slide, but it's really simple. All it says is that the total value of the company's tokens should equal the total value of its assets. And because the company only has one kind of asset here, which is future production of phones, you can set these two things equal to each other. So what we get is that in equilibrium, the token value is given by revenues divided by total tokens, the token supply n. Now the revenues in our case are captured by customary willingness to pay times this min function here, which is the min of Q and D. So the min of how much I've ordered versus how many customers show up. And so the whole function together just represents sales volume for the product. So if sales are zero, what happens if you don't sell any phones? Well, you're left with a bunch of phones that you've produced that no one wants. And because there's no salvage value in this model, the token value goes to zero in this case. You set min QD to zero, you get tau F equals to zero. Beyond that, I think the expression is in line with intuition. So it basically shows that token value increases in customary willingness to pay V, and it increases in realized demand. So the more demand there is, the higher the token value will be, and it increases in overall sales, basically. And it also decreases in dilution of the token supply. So the more scarce the token is, so the lower the M, the more valuable it is. So if M goes to infinity, for instance, what happens if a firm decides, I've changed my mind. My total tokens is not M. I'm going to print some more for myself. I'm going to print, an infinite amount of tokens. Well, I completely dilute people. So the assumption of the model is that M is fixed and it's committed through a smart contract. Okay. So, that's not the main, this formula is not the main takeaway. The main takeaway is the following. If you recall, speculative utility function also depends on this token value tau X. So this means that when a firm issues a utility token, in the context of asset tokenization at least, it's actually equivalent to engaging in a revenue sharing contract with speculators. Right? But to also go one step further, because revenues depend on future demand, this also means that the firm shares demand risk with speculators. So why is this different than traditional crowdfunding? I think is an interesting question. So in traditional crowdfunding, people give money in exchange for a promise that they'll get a product in the future, right? Now, whether future demand for the product is low or high is mostly irrelevant to an individual crowdfunding backer. Right? Unless, of course, the product itself is very sensitive to network effects, right? If that's the case, then that's not true anymore. But if it's not sensitive to network effects, if you're a backer in a crowdfunding campaign on Kickstarter, you're not really taking any demand risk, and you're not sharing revenues with the firm. You actually don't care how much money the firm makes. as long as it reaches its cap and it produces the product that you paid for, right? If it doesn't, you get your money back in those cases. So in ICOs, it's the opposite of that. So in the absence of network effects, there are no network effects anywhere in the model. You still get this revenue sharing mechanism that occurs because of these speculators that are able to participate because of the secondary market that comes later. All right. So on that note on the secondary market, let me just say one last thing, which is that all of these previous results are actually tied to the existence of a secondary market. So speculators would not be able to monetize their tokens if they didn't have a liquid secondary market. And the existence of this market really incentivizes speculators to participate in the first place, right? But also from the firm's perspective, the fact that the firm can retain tokens, not sell all the tokens in the ICO, and then offer tokens, competing with speculators in the secondary market, it actually ensures that the firm maintains enough skin in the game to engage in production after the ICO, absent any sort of regulation. So hopefully it should be clear that the secondary market plays a pretty crucial role for utility-based tokens. All right, so I have about 10 minutes left. Maybe if that's not true, please stop me, Henry. I thought of just talking about—
Gerry, I was gonna say, I think you can go, you know what, I think I'm giving ourselves sort of an hour and a half. So I think if you want to run 5 or 10 minutes later after that, that's fine.
Yeah, it's not going to take long. I just want to quickly give you an overview of some of the interesting extensions that can be found in the paper without really getting into the details. So we explored, what would have happened for this company, for Sirin Labs, if it issued equity tokens instead. And we also added technology risk. You can imagine that not every company has Foxconn, not every company has, Lionel Messi. And, we made the speculative utility also a little bit more realistic in the paper. I'll just briefly mention the first two here, and the third one, if you're interested, you can take a look at the paper. Okay, so let's take a look at the equity token case. So I had two main reasons I really wanted to explore this. So first, as I mentioned earlier, ICOs took a pretty big hit towards the end of 2018 and in 2019. At the same time, STOs, the equity tokens, increased significantly in 2019 in terms of market share. And the explanation provided in practitioner circles with discussions I've had with a lot of people is that because STOs are regulated, it means that there's much less risk for investors, so they're more willing to go in, and we've kind of gotten rid of all the early movers anyway over the course of 2 years. And so we shouldn't be too surprised that this is happening, just as the regulatory environment is becoming increasingly more mature. Now, in our model, here's the thing. If we assume that we can regulate away moral hazard, and we just study STOs, we just recover the Modigliani-Miller theorem, which says that we get the first best outcome. So the trivial conclusion then would be that regulated STOs that completely eliminate moral hazard would be superior to unregulated ICOs in all cases. But this is only, of course, if the cost of regulation does not exceed the agency costs of unregulated token offerings. So this is a pretty trivial analysis. I'm not going to show it to you, but I think there's something a little bit more interesting here and a little bit more subtle, which is the question of what happens when both of these designs are subject to the same underlying source of moral hazard. So the reality is that regulation cannot imply absence of moral hazard. And you can look at a company like Wirecard just a few months ago in Germany that was one of the fintech darlings that got completely shut down because of fraud, just massive fraud that was going on there. So, and it was heavily regulated, right? So regulation does not automatically translate into absence of moral hazard. I would argue it maybe translate into a reduction of moral hazard. So I think it's still relevant to study STOs in the presence of moral hazard. So this was really what we wanted to do, is to compare STOs and ICOs under moral hazard. There's a second reason that we wanted to explore this, and this is the realization from the previous model that ICOs are essentially a roundabout way to implement revenue sharing. through the secondary market. So if you're going to implement revenue sharing, why don't you just directly implement profit sharing, which can be done more directly through equity tokens? You don't need a secondary market per se. And that's one of the advantages of equity tokens. I mean, as long as you could write a smart contract that holds product sales proceeds in an escrow account, it's there are some practical issues that you have to get over in terms of how the money, gets released, etc. But if you could do that, it would be a straightforward way to distribute funds to token owners. So, in theory, you could implement voting in this way, although most STOs don't include voting rights, so we didn't study voting rights. So voting rights here would be, having a say in the production decision. So we didn't do that. So here's the math for the token, for the equity token case. It's very similar to before. So you have the ICO proceeds left, but really what we're doing here is that we have expected total profits minus the share that we've promised to the speculators, or investors in this case. And there are some equilibrium quantities here. We're using the market clearing condition, and you get this arrow use vendor form that pops up, etc. But let me just skip to the results here. So what do we find? Well, we find that equity tokens actually outperform utility tokens in the context of asset tokenization, especially when margins are lower. As margins increase, these two things kind of meet. But for lower margins, equity tokens are better, even though you're selling a phone. And this is not due to the equity tokens being regulated, right? There's no regulation in this model. It's more simply because they actually do a better job at aligning incentives between the firm and the investors. In a nutshell, they're just less agency costs in equilibrium. But to be able to achieve this, it actually affects how you design the STO, the parameters, how many tokens do I give out, how do I price them? So let me show you these results here. So these plots are sensitivity to profit sensitivity to, sorry, not profit sensitivity. The ICO cap sensitivity and the token price sensitivity to willingness to pay, which was the parameter V in the model. And it's actually versus the margin, but because the margin is V over C, I've normalized C to 1. And so you could even think of this as the margin or willingness to pay. So on the left, I'm plotting the ICO cap for both equity tokens in the dotted line and utility tokens. And you can see that if you do equity issuance, the model predicts that you're going to put more token, you're going to give out a larger share of your company to investors in the ICO. And on the right, what you get the benefit of actually reducing the ICO price. So even though you issue, you issue more tokens, you have a lower price. Now, the net effect is actually that you raise more money when you combine, the product of the amount of tokens sold and the token prices. It's the product of these two curves. You get that you're actually raising more money in expectation when you do an STO compared to an ICO. Okay, and here are the two main results for the rest of the model, for the entire model actually. So on the left, we have optimal production strategy so this is Q as a function of product margins. And we're comparing ICOs with utility tokens to STOs, which we call here equity ICOs. Maybe, this was written a few years ago, so the terms have changed a little bit now in practice. And we compare both of those to first best, which is the first dotted line there. And you can see the two different regions of underproduction. So in the region 1 to 2, there's zero production, both under equity and utility, but there is first best production because this is still a profitable firm. So without the frictions, you still get investment. But beyond that, once the V hits 2, so the margin hits 50%, then equity ICOs really start aligning themselves very quickly with first best. And utility ICOs are dragging along. It takes a little bit longer to, it takes much higher margins to be able to get there. Okay, so the right plot is the view in terms of the final wealth of the firm that's doing the ICO. And the difference between all these curves, which I haven't plotted here, is just represents agency costs. So ideally, this is how much profit is embedded inside of this product. You can't reach that, either with equity or utility ICOs, but you start performing a lot better once product margins start increasing. We did a bunch of numerical experiments just to have numbers kind of in our heads. On average, the agency costs are quite severe, as you can imagine. They're about 30% on average for utility tokens and about 20% on average for equity tokens. Okay, so there are some interesting implications here, but also some limitations of these results. I'm not trying to advocate that equity tokens are always better. There might be other reasons in practice why firms would still prefer utility tokens that we're not capturing the model. In fact, when you throw in network effects and other things, other papers have shown that you can flip the other way with other things, right? But keep in mind, this is really a specific context of asset tokenization, right? The paper is really focused just on that. We're not giving generalities for the entire ICO market. So in terms of insights, I think the idea that STOs perform better provides a more subtle narrative to explain the fact that STOs have been gaining market share recently. Right, from a regulatory perspective, I was able to speak with the SEC. What I recommended was that, you have limited resources to expand. You should actually focus those resources on regulating utility ICOs, because there, at least in this context, the propensity for moral hazard is higher, and especially for fraud, which is just raising money and running away with it. And this is exactly the type of thing that the SEC is worried about and they're trying to protect against. But somewhat paradoxically, they're really, I understand why they're doing it, but they're really regulating equity token issuance, and they've left utility token issuance on a case-by-case basis. They basically, they let people do whatever they want, and then ex post, they try to go attack people that have done utility-based ICOs, because they're not registered. Now, I don't know if my recommendation had any bearing, but nonetheless, that's one of the takeaways of this analysis. Okay, so the last thing I'm going to go really quickly on this is technology risk. So like I said earlier, you might think, well, what if the phone production fails? So we added this extra probability of, exogenous probability that the firm's technology is viable. And it changes a lot of things in the model. So the margin requirement is now depending on this probability. So V has to be bigger than 2C over alpha, which means that 50% is not going to cut it anymore. You need a higher margin depending on how risky the technology is. But we still find that ICOs are feasible even for risky products. But one thing that was kind of interesting in the results is that when there's a risk of production failure, it actually is rational for the firm to divert a little bit of funds in equilibrium. And speculators are okay with that. They still break even in expectation. But of course, you need much higher margins for this to work. This is the plot of the technology risk. So there is a region where you divert funds. And let me start concluding here just by mentioning that I think there are some empirical implications of this theory paper. In the grand scheme of things, this is kind of one of the earlier papers that was, again, to the best of my knowledge, that was written on ICOs. And there's a few things that I hope, my colleagues, my empirical colleagues can check. If I did it, I would probably do a very poor job. So the first one is that higher margin goods lead to more successful ICOs and vice versa. The second is that, a similar statement with respect to customer demand volatility, which has to do with how uncertain and risky the product is. The third one is the advantage of equity tokens for product market firms. And the last one is that riskier products lead to less operating investment in terms of funds raised and require higher margins. Now, this is just to provide a little bit of high-level guidance, for people who might be curious or who might have data sets that they could probably check this or refute some of these findings. Okay, this is my last slide, just a recap of the results. So let me just summarize. We found that asset tokenization is viable even in this kind of hostile environment, in the sense that equilibria can exist in the absence of regulation, but of course, moral hazard, as we could have expected, creates very severe distortions. Now, on the question of how do we design ICOs, We have some, semi-closed form solutions, etc. But the main high-level takeaway is that holistic design is really important. The ICO design strategy, the operating strategy are entangled. They can't really be separated. And the paper shows how these depend on customer demand characteristics and product characteristics. The second takeaway, we provide some guidance, some conditions on some kind of minimal requirements that you need to make sure that ICOs work out without regulation. But even if these conditions are met, we find that agency costs are very significant. They can, go up to 100%, meaning there's no investment. They can go up to 50% easily for margins that are close to 50% margins. So finally, the secondary market turns out to be quite critical for raising funds and for dampening moral hazard at the same time. And on the question of utility versus equity, equity is better in our model because it better aligns incentives, but that does not necessarily generalize to other settings. Okay, so Henry, I'm all set.
Okay, thank you. Yeah. Thank you, Gerry. Okay, so I've got a few questions, and then of course, please feel free to text me or just raise your hands, and I can see the participants. So Lian, Professor Lian Yang, you had a question. Actually, I may just ask you to ask Gerry yourself, if you're there.
Okay, thank you, Henry. Thank you. Thank you very much for the great discussion, this presentation. I have a question regarding the first setting when you talk about the problem of the firm. So there you assume the firms always require the problem always satisfy the participation constraint of speculators. I'm thinking, so whether that analysis is complete, maybe you have to consider two regimes. In the other regime, the firm may not allow them to participate, and you compute the maximum profit they can obtain just selling tokens to consumers. And then you compare this maximum profit or revenue versus your regime, which allows those people, those speculators to participate. I think that seems to be a more complete analysis to me. So now you just assume the kind of default regime is kind of those participation, those speculators participate. I'm not sure whether that's optimal in equilibrium. That's a technical question. Thank you.
Yeah, so thank you very much for the question. So if I understood correctly, this idea of having two regimes, I think would require a kind of a completely different model, because in our model, we need to raise funds from someone, and that someone are basically speculators or investors. You can call them, one or the other. So without them, if they don't participate, the firm raises nothing. So we would need a completely different utility function. Now, we tried to extend the utility function of speculators a little bit in the paper. We looked at situations where the outside option is not zero. So, and in reality, the outside option is not zero. They want, speculators want to have an expected amount of return to participate. And so we've done that analysis, but I think it would require a kind of a fundamentally different model to go after the point that you're mentioning. Perhaps mixing, people that are both interested in buying the product and want to speculate on the price, or take kind of the max of these two things, for instance. That would be an interesting, I think, extension. And then, as you mentioned, the fact that the firm might have ex post control over, when to stop the ICO or how many tokens to issue. Now, all of these commitment issues or lack of commitment issues, are very important in practice. Some of them can be resolved through the use of smart contracts. Not all of them, probably, but some of them could. For instance, the fact that you can't issue more tokens, this could be, embedded inside of a blockchain. The fact that you can't prevent people from participating, or, that should probably, you could probably write that. I'm not a coding expert, but I think you could probably capture some of that in a smart contract setting. Thanks.
Thank you. Thank you very much.
Okay, thank you. I have a question from, I wasn't quite sure what you were asking. I have a question from EUZ. May I ask you to sort of ask Gerry yourself, because I wasn't sure exactly what you wanted to ask. Are you there, EU? Okay, so I don't hear from them, so I'll ask, because I wasn't quite sure, because they asked a simple question. They said, what if Q equals 0 is the optimal profit? Seems like it's so.
Yeah, so Q0 can happen in the model, and it happens here. It happens for all situations of V between 0 and 2. That's, sorry, that's Q0 because there are no funds. It can't happen in the model that, you're in this regime and you actually set Q to 0, because you're always, as long as the margins are high enough, the firm always prefers to go after those margins as opposed to running away with the money. And that's what makes this work. So this is a really simple model, but you can think of in practice, if I raise a bunch of money and I'm not really, I can run away with it. What keeps me in the game? And what keeps me in the game is that, actually, if I invest this money, I know I'm going to make more than just running away with it. And that's the basis of investment, right? Is that when you invest in something, you expect a return, right, on top of the amount of money that you generated. So Q equals 0 is prevented in this model by the fact that the firm retains tokens for itself in the secondary market, so it can make money by selling its own product.
Okay, I'm going to ask you actually lots of questions. This is great. First of all, just for clarification, just so that I understand. So when you mean utility tokens, so is it tokens like a pre-sale for a future product? Is that sort of your
yes.
Okay, so and then equity token is exactly like share of ownership of the company. Is that right?
Exactly, but without voting rights.
Right. So again, maybe this is too complicated, because it strikes me that a firm could have both, right? If you actually had several products, you could have a utility token for each product, and you could also have equity tokens. Would you do that? And analysis, I'd imagine, would be really difficult. So can you speak to that? Because that sounds interesting to me.
Yeah, so I think, I can't make the inference based on the work that we did, because we didn't explore this question, but in practice, you do see that. Of course, you didn't see it at the beginning. When we first started writing this paper, it was like 3 or 4 years ago, the market was just being born at the time. So they didn't have all these interesting, twists that you see now. And you do see firms issuing both, because they serve different things. My guess is that, this that will be the equilibrium, if I had to guess. If you put a gun to my head and ask me, I would guess that, the equilibrium is probably going to be a dual issuance model, and you do see this in practice. But I haven't studied. I think it's a really interesting question. We've started looking into some aspect of it in this other working paper that's not published yet that we're writing now, but we don't have the solution to that.
Okay, thanks. Another question that struck me. So, when you're talking about phones, there's sort of a reasonable nominal price for how much that phone could be, right? Because it's a physical product, they're reference points. But if we're talking about even things that are more sort of intangible goods, like it could be an NFT, or it could be like even real estate or something, or even service, is there some sort of a disadvantage to this kind of a product token, because there's a cap in how much you can make off of that, because it is physical and people kind of have an idea? Like people can do cost-based pricing, for instance, versus something that's more intangible where the price is much more difficult to establish.
Sorry, Henry.
So what I mean is, like when you talked about utility tokens for products, like physical products like this phone, right? There's sort of a nominal sense of how much a phone would cost. It's probably not going to be $10,000, right? Whereas some of the other things that people are trying to make a utility token for, say, like fractional ownership of violins, for instance, right? Those things they don't have such a nominal price. It could a Stradivarius violin could sell for 10 million, it could sell for $100 million. So have you investigated that difference? To me, there's a difference between a physical good and how much one could expect from that token investment versus sort of a more intangible good.
Yeah, absolutely. I think I caught most of it there. Great Great questions. We started exploring that, but we got scared off by the competition. Just too many people that were working on ICO papers. So we decided to kind of, and it was also the product of the review process. You know, you can't really control everything. So we decided to take a narrow approach here, to just have a really narrow topic and try to go in some depth into it, as opposed to, you know, trying to generalize. So yeah, I think that's a great question. I don't know the answer to it. That would be interesting work.
Okay, thank you. I'm just going to do one last plea for questions. Again, we're bringing it pretty close to the limit anyway. So are there any other questions? I do have one last one, which is, I don't see any, Gerry. So I guess last one, just speculate for us, because there's so much topic discussion about non-fungible tokens, right? So I just wondering whether you're looking at it, or whether you think that's, you know, whether, oh, I do have one message, but yeah, where you can go with this.
Yeah, I mean, I've been following the news like a lot of people, and it's a mix of being not surprised and being, yeah, we've seen this before with the ICO boom itself, and at the same time disbelief, because, you know, the types of NFTs that are sold really are not backed by any physical good. And, you know, I think a lot of this is, I think NFTs are going to stay, but I don't think we're going to have the crazy, I think we're just in this boom period where, you know, everyone's excited, just like they were about, you know, with ICOs. But, you know, what do you need for NFTs to be successful? You need something that people are willing to trade, and something that increases in value. And so, for instance, owning Dorsey's, you know, first tweet ever, what does that mean? You don't actually own the tweet, you just own, you know, the rights to what type of property. It's not even clear, because you don't have his account. It's not like you can do anything other than tell people, hey, I bought his first tweet, but I don't control it because it's in his account. It's not even in my account. So I'm not entirely sure. You know, I think there's a little bit of a disconnect in this market at the moment, but I don't think it's going to disappear. I think it's fundamentally, it's just it's not a new idea. It's just, you know, we do this outside the world of blockchain. You know, people buy works of art, etc. Of course, there's a physical product there, and in this case, the physical product would be a digital image, for instance, would be the equivalent of a portrait. And you can imagine that, you know, as you would lend out a painting to a museum, to maybe for free, maybe for some money, you can actually generate you know, funds from your asset. You could think that you could also do that with an NFT, where you could generate funds through the asset that you acquire. That part is more solid to me. That part, I think, is going to make sense. For instance, you get royalties for music or other things like that. That part makes sense to me.
Okay, so I guess what I'm hearing is that I think under certain characteristics, like the royalties to music, you could, as an operations and finance person, sort of model that. For otherwise, the other thing about is just, hey, there's a buyer for some idiosyncratic thing that I have. That's more difficult to model. Maybe that's more of a marketing domain kind of a question.
Yeah.
Okay, I got you. Okay, that's good. I actually never thought about that before, but I think that's really wonderful. Thank you very much. And Gerry, this paper was published, right? Just so that people know. Just recently?
Yes, it was published a few months ago. I don't exactly remember the date, but yeah, it was.
And in management science, right?
Yeah, it's in management science. You can get it from my website.